Alright guys, so look at this 5-year chart. You gotta be flipping my flapjacks. Wow, 203% up this stock is in the past 5 years. Absolutely tremendous performance. This stock has well outperformed the NASDAQ. It has smashed the Dow. It has smashed the S&P 500. And don't even compare it to the Russell 2000. It's a night and day difference. This stock is absolutely a beast. 200+% in the past 5 years. I sold the stock a few months ago, or a couple months ago, right? 2 or 3 months ago or so, roughly, right? And I regret it. And look at this. This is their latest numbers that just came out a couple days ago. Their revenue's up 14.5%. Their income from operations is up around 50%. Their net income's up 46%. Their diluted EPS up 46.4%, right? Their balance sheet is absolutely as pristine gets. $197 million in cash and cash equivalents. No debt on this company. They're now up to stockholder equity of over $1.2 billion on this company. Absolutely incredible. Since this company went IPO 20 years ago, went IPO in 2004, the stock is up 1,371%. Absolutely smashing the NASDAQ's return over that time, smashing the S&P 500's return over that time, and smashing the Dow and the Russell's performance over that time as well. $100,000 in the stock at IPO would now be worth close to $1.4 million. Absolutely incredible. Now, if you also factor in the dividends you receive from the stock, you're likely well over $1.4 million if you had invested those dividends along the road. You might be closer to like $2 million now. Absolutely incredible what this stock has done. This stock is Texas Roadhouse, a restaurant chain. I mean, this isn't some new age software company, some AI specialist. It's a flippin' flapjackin' restaurant. You gotta be kidding me, right? They sell steaks and ribs, and they got those delicious rolls that you go in there and the little cinnamon butter. Oh, baby, those are good, right? I went with my kids last night. My wife was going to a concert, so I took my 3 boys. We went over to the Roadhouse. Phenomenal, as always. After tip, for the 4 of us, it was like $64. $64 after tip. And I tipped like 20%. It was like, I think the bill was like $53, $54. And I tipped 10 on top. Like, where are you getting out of for 4 people? I know it's kids, like 3 of them were kids, but still, like, for under $70 nowadays, that's insane, right? And it was delicious. And we had leftovers. Right? Now, why did I sell this stock? Well, the reason I got out of this stock is the valuation. The valuation got very stretched on Texas Roadhouse. The forward P, if I look at, because I own 2 restaurant chains. Now I own 1 restaurant chain, but I had owned 2 restaurant chains, Texas Roadhouse and Cheesecake Factory. And if I looked at the forward P, the 2-year forward P, Texas Roadhouse just way above. It's like over a 2x above Cake. And I expect Cake to have somewhat comparable growth in 2025 and beyond when it comes to amount of locations opening, like same-store sales, those sorts of things as well. So I looked at valuation, and I was just like, valuations got really stretched on Texas Roadhouse. That's why I got out of it. Not because it's a bad company. It's a great company, obviously, right? Now, Cheesecake is coming out with their earnings of, 3 or 4 days from now, right? And I'll be honest with you, I don't think Cake's numbers are going to be as impressive as Texas Roadhouse. Texas Roadhouse has just been executing at a higher level than Cheesecake. Now, that does not mean Texas Roadhouse forever is going to be executing at a higher level than Cheesecake, but the bottom line is, and the fact is, Texas Roadhouse has been executing at a better clip than Cheesecake Factory, just factually on a numbers basis, right? And so now we got these Cheesecake numbers coming out. I think the numbers are going to be good, but they're not going to be as good as Texas Roadhouse. Bottom line, those Texas Roadhouse numbers are special, right? And we can see this in the year-to-date performances with these 2 stocks. Look at Texas Roadhouse. Texas Roadhouse up 40+% this year, right? Cheesecake's up 11%. So Cheesecake's doing good. And let's say Cheesecake has a good earnings, the stock goes up. Next thing you know, the stock's up 20% year-to-date. That's good. That means Cheesecake's having a really good year, right? But even if it's up 20% for the year, it's still getting over 2x'd by Texas Roadhouse. Texas Roadhouse up 43%. So let that sink in for a moment. That's the difference between a stock doing great and a stock doing good. It can be massive differences in kind of alpha here, right? So a lot of people ask me, why not sell top positions? When I have these top positions, they've made me a ton of money. Why not sell out, right? And this Texas Roadhouse example is exactly why I don't like to sell out of top stocks, like really great companies, because you end up regretting it. I regret already selling out of Texas Roadhouse, and it hasn't even been very long. And so when you own truly great companies and you sell those companies just because, well, I've made a lot of money, it's usually a bad decision. You should usually just hold them, just to be quite frank. And if the story ever changes and you feel like that company's not being such a great company and it's, moving down the tier to maybe a good company or average company, then you can get out of it, right? But when a company is executing at the highest level possible and is making you money and the company's numbers are absolutely phenomenal, it's usually always a bad decision to sell, even when it's valuation based, as it was in my case with Texas Roadhouse. And so this is why I don't usually do this, because I end up regretting it, right? There was a time period where I used to own around 10,000 shares of ELF. I own 1,000 shares of ELF. Do you think I wish I owned 10,000 shares of ELF today? Of course I do. Because it would be like $1.8 million worth of just ELF stock alone. Of course I wish I never sold one share of ELF, ever, right? And so when you own truly great companies, truly great stocks, it usually doesn't make sense to part with them. Everybody always, they make a profit, as I made with Texas Roadhouse, and then they want to get out of it. If the company's executing at even a higher clip than you expected, it's better you just hold the dang stock and go through if you own average stocks, companies that aren't that good, and you make a profit, get out and run. But when you own truly great companies and they make you a profit, like let's say Amazon, right? Amazon, we've made $79,000 on that. So I could look at Amazon. They report earnings this week. We'll speak about in just a moment if I think their earnings are going to be good, whatever, right? So 70% I made around $80,000 roughly. I could look at that and I could say, man, let me sell my Amazon shares because I made around $80,000 of profit and I have $192,000, right? What am I going to do with that $192,000? What am I going to do with it? Let's say I take it out of the market. Okay, I'm going to put it, in a savings account? Do you think a savings account over the next 5 years is going to outperform Amazon stock over the next 5 years? I could, buy another real estate investment property or two with that $192,000 and use that as down payment. Do I think my real estate investment property is going to yield me better over the next 5 years than Amazon stock? No, of course not. Of course not. Like Amazon's a truly special company with several truly special business models. Between the AWS side, plus the advertising side, plus the e-commerce side, those are three special businesses they own. Like my real estate property would not outperform Amazon over the next 5-10 years, nor would a savings account, nor would a CD account. So when you look at it from that perspective, it's like, then I could put it into another stock, okay, right? I could, but why would I sell a truly great company just to put the money in another, what I think perceive is a great company or could be a great company? Usually it just makes sense to hold and then buy a new company with new money. Or sometimes you're going to buy companies that aren't that good, right? And then you can move money out of those companies that you then realize over time, oh, this isn't actually that good of a company. And you move that that money from a weak company into a much stronger company, right? And so I've done that before where I thought, oh, I'm buying a good company. Like, you're going to have a fail, right? In the stock market, like there's no such thing as winning them all, right? I was actually somebody shared a great clip in the private group that I got to see just a little bit ago. And they shared this clip. It was from 2007. And it was like Tiger Asset Management or whatever. And speaking about some of the problems they could see coming in the market. But while I was watching that, there's toward the top of the video, CNBC video, right? They're talking about Warren Buffett. And they're talking about Warren Buffett just took a big stake in, it was Burlington Northern at that time. This is like 2007. And then two other railroad operators. No, the railroad operators at that time were right around all-time highs. This is incredible. And then right after that happened the great financial crisis. So even the master Warren Buffett can get his timing horribly wrong. Like he should have waited a year to build out those positions because he could have bought those railroad stocks for so much cheaper. But you have a fail rate in the market. It doesn't matter how great you are, you're going to miss some, right? So let's say you think you bought a great company or you think you're getting into a great stock, and over time you realize, this isn't quite it. Okay, it's time to move on. I've done it plenty of times in my 15 years of being in the market where I got in, I was excited. I'm like, oh, this is going to be a good company. It's going to be a good stock. And then they report over time and I realize, oh, this isn't quite going the way I thought it was going. And I made a mistake here. And then I moved that money from a weaker company into the next company that hopefully is a much stronger company. And as long as you're a lot more right than wrong, that's all that matters. I can tell you in the past 15 years in the market with the stocks I bought, a whole lot more right than wrong. And that's all that matters in this game, right? And so, because you will have a fail rate. Everybody does, including Mr. Warren Buffett, right? That's why a lot of times it doesn't make sense to sell top positions. You're just going to look back and you're going to likely regret it. Weak stocks, okay stocks, cash out of those, move them on. Hey, I want to thank you so much for watching that clip. I hope you really enjoyed it. What I'm showing you in front of your face right now is 1000xstocks.com. This is such an important website and service to use if you want to research companies, if you want to understand companies on a high level, so you can hopefully get better results in the market. And we know as the years tick on, money compounds. It is so important you research companies, you compare companies, you're listening to conference calls, looking at SEC filings. All that's included into 1000xstocks.com. So to enjoy 1000xstocks.com and to apply for that service, you can go to the description area of this video, or you can go to 1000xstocks.com, whichever you prefer. Rotation of small caps mean we are likely to see a slowdown.
Performer again this week.
Once again, as I said at the beginning of this video, remember this gentleman has definitely, I've watched his commentary for the last couple of years, he's definitely sounded bearish bear over the last couple of years.
Finishing up 3.5% on the week, third straight week of gains for the small caps. Do we have legs here?
I don't think so. And I don't think so, meaning that the catalyst to reversing or abating some of this small cap outperformance is likely three things. The first is earnings. Leadership is going to be leadership. And we're already seeing that from the communication services and the information technology sector, where we're seeing 150 basis points of net profit margin expansion, where we saw Alphabet put up 30%, where we're likely to see some of those other names put up earnings that far surpass earnings that we've seen from a broad perspective from other sectors. And that is the expectation. We came into this quarter with communication services looking to put up 20%, with information technology looking to put up around 17%, the top two expected numbers in terms of consensus. The second thing that I think will come into play in terms of this rotation of small caps abating is that we're likely to see a slowdown. And we can argue or debate or presume the magnitude and the duration of it, and it's probably softer than many of us imagined weeks ago, but it's still likely to happen. And so the Fed's announcements thus far abate some of the balance sheet risk to smaller names, but it doesn't remove any of the hazard in terms of top line growth or bottom line growth. That's likely to be consumption driven. And so we have to go through that slowdown. We'll see leadership reemerge from an earnings growth and margin perspective. And then when they do start to cut rates, it will be much, much slower than the pace at which they raise rates.
Okay.
So it will take time for some of those hazards to pass us by.
Okay, so you're not...
Whoa. Hold your horses for just one flip and flapjacking moment, okay? Listen, when the Fed starts lowering rates, which probably is in the next couple months, okay, they start lowering. We don't know how fast they're going to lower. That's just reality. You can assume something's going to happen, but your assumption's likely wrong significantly. No different than when the Fed finally started raising, no one had any clue how high the Fed was going to go. Every single there's not one person on Wall Street that I had seen that had predicted where the Fed was going to go with Fed funds rate. Not one. Not one Wall Street firm, not one analyst, no one predicted the Fed was going to move to 5% plus that quickly. I didn't see anybody predict that. And it happened, right? So now to try to assume you're going to know how fast or slow the Fed's going to lower interest rates, that depends upon so many various factors. What happens with inflation? What happens with the economy? What happens with the jobs market, right? There's a lot of things at play there. And so, yeah, I think it's dangerous. I mean, when I look out there, yeah, I do think the Fed's going to start lowering very soon, but I'm not going to bank anything on how fast or slow I think the Fed's going to lower rates, because I'm just telling you, you're not going to be accurate whatsoever. The Fed doesn't even know. The Fed doesn't even have the first clue about where Fed funds rate's going to be a year from now. The Fed, Jerome Powell himself, has no conception of where the Fed funds rate will be 1 year from now, especially 2 years from now. 2 months from now? Sure.
A little bit of pun intended. Drew, want to get your thoughts on this rotation we've seen, how sustainable it is, and on a day where the S&P jumped 1%, it looks like we're closing right around 54, 59 here. How does this set up for next week, which is going to be the busiest week of earnings for the season?
Look, I think the setup for growth is going to be a lot more difficult heading into next week. So Megacap growth specifically here. So look, we can't deny the price action there has been really aggressive. Yes, the fundamental momentum's been very good, but at some point you just have to have a little bit of caution when prices move that far ahead of fundamentals. To us, we think growth takes a bit of a pause here. This rotation could have some legs for now, but a lot of these structural winners likely kick in. But look, just to make it real simple, they have to beat in rates. You can't just have one or the other this quarter, especially for the Mag 7 names that haven't reported yet.
Okay. So, Greg, you're basically saying, and you write this.
I mean, to be fair, that's what these companies are always basically have to do. They almost always have to beat and raise, just to be honest.
This isn't the great rotation. It's an overstretched rate cut rally. What would you be buying then, if not small caps?
So I think I agree with Drew here. The key, the secret sauce is what's going to deliver on 20% plus earnings growth. And when you're banking on 20% plus earnings growth, what you want to see is something tethered to secular tailwinds, generational secular tailwinds, in the case of AI and cloud, et cetera. Or you want to see some structural supply-demand imbalance. And so I'm not saying that we haven't picked at the small cap ocean or basket. What I'm saying is that we're doing it selectively, and we're looking for that structural supply-demand imbalance, or we're looking for a generational secular tailwind. So when you look at shipping, for example, we've talked about how the shipping rates for a 40-foot container from Asia to Europe is 5 times what it was a year ago. Well, there's small cap ways to play that, and Zim and Matson. And yes, they're up a bit this year, but the earnings growth in that sector should be fairly powerful and aggressive throughout this year in 2025 because it takes some time to bring on the capacity. We can talk about, for longer term trades, the rotation into green energy, electric vehicles, and while copper's gotten most of the attention in those areas, there's lithium, there's uranium, and so names like Arcadium and NextGen, both under $5 billion. Obviously, the decreased risk of financial duress, particularly given what they have to invest to acquire and develop their properties.
O'Reilly Auto Parts.
Better access to capital, more widespread access to capital, and at better terms, obviously, advantages those companies. And at the same time, we have access to that supply-demand imbalance, because as we all know, that the surge in demand for those precious metals far outstripped the...
Wow, super micro down big. The super micro stock's interesting because recently I was under the assumption that the super micro company was a company in which the valuation was completely out of control. But you look, and it's like, no, it's not actually. Trailing 12-month P 39, forward P 23, 2-year out forward P 16, based upon kind of what analysts are expecting here. So the super micro is actually really interesting, very interesting. It's not like a crazy overvalued company like you might assume because the stock went up so much, right?
For projected supply over the next 10 years.